Okay, good morning, everybody. Thank you for joining this webinar. It's just a couple of minutes past the hour. Probably more will attend as we start, but we've got a busy sort of presentation ahead of us. We've got 3 speakers from Bloomberg. So thank you very much and welcome to Reshaping Asset Allocation into the New Decade. Hopefully all of you will have known about Bloomberg, but just a little bit about them. Their professional services, including their terminal and enterprise data management system and services, provide real-time data, breaking news, in-depth research, powerful analytics, and world-class execution capabilities to help financial professionals make smarter, faster, and more informed decisions. We will have 3 speakers today from Bloomberg, and we will have some polling as we go through the session. So if I can hand over firstly to Mahesh, he will introduce his part of the presentation. So we can have the first slide, please. So Mahesh Bhimalingam is the Chief European Credit Strategist at Bloomberg. And as I said, he will commence the presentation, followed by Bobby Lilaram, and then Fred Weld Forrester will conclude the session. And then we will go to Q&A. So please do, as we go through the session, put your questions into the Q&A and we will then revert to those at the end. We'll have plenty of time for questions and I'm sure we're going to get into some really good discussion with the 3 panelists. So if I can hand over to you, Mahesh. Thank you very much.
Thank you, Adrian. Welcome everyone to this webinar on Reshaping Asset Allocation, co-hosted by Bloomberg and PLSA. I am Mahesh Bhimalingam, Chief European Credit Strategist at BI. BI is Bloomberg Intelligence, which is the research arm of Bloomberg. I come here to Bloomberg after 20 years of being Bloomberg customer. I've been in 4 investment banks, being head of research teams at Lehman, Barclays, Deutsche Bank, and BNP Paribas. Headed credit strategy, global head of EM credit strategy, etc., etc. The thing is, BI essentially functions like any investment bank research, except that we just cannot give buy, hold, sell recommendation. Otherwise, it's as in-depth. In fact, it is the broadest research platform on the street as of now. Can we move on to my first slide, please? Next slide. So today I've been asked to talk about European outlook, big picture, but of course focus on credit, which is my day job. So if you look at this slide, what is the outlook for 2021 and what are the numbers predicted for 2020, both Europe and US? On Bloomberg, the Bloomberg terminal, which is what the core product of Bloomberg is, you have all these functions that you could use. It's essentially, there are probably a million functions, but the most common ones I'll highlight as we go through our webinar. So this is ECFC, economic forecast. So the street median forecast for Eurozone this year is minus 7.5%, so 7.5% down. Expected recovery by about 5% next year and another 2.8% 2022. So given the smaller base, effectively it is going to take about 2 years for the Eurozone to recover what we're going to lose in 2020. Inflation is going to dip down well below the ECB target. It will recover to about 1% and get to 1.3 by 2022. In the US though, the drop is much smaller, about 3.9%, but after that, it is going to recover quite fast. So, which means the US is most probably going to recover what we lose in 2020 by 2021 itself. First thing, it is not going to lose as much, and also the recovery is faster. Next slide, please. So what does that mean for markets? Obviously, on the terminal, once again, we have a very, very useful function used by the entire street, BYFC, bond yield forecast. And here you got the front end rates as well as the long end rates, the entire curve, along with the 2-10 spread for US, Germany, and UK. And you can clearly see from where current spreads are, which is the leftmost column, to the end of 2021, the pickup is very minute. We are talking about 10 basis points in the US. We're talking about 25 basis points in Germany, and basically flat in the UK. So gently wider yield outlook. So we're not going to have the sort of whip, at least the market seems to predict that we're not going to have this sort of huge whipsaw that we saw in 2020, thanks to Corona and the resulting stimulus. Now, in such a scenario, when rates are going gently wider, which asset class should you be? I think that's the crux of this whole webinar. In such a scenario, when rates are gently going wider, one asset class that tends to do extremely well is credit. Why? Because then the correlation is negative. Wider rates lead to tighter spreads. So you will have positive excess returns. Move to next slide, please. So this slide shows you the blue line is the Euro investment grade index spread, yield, and the orange line is the Bund 10-year. You need to realize the Euro investment grade is not a 10-year product. It is about 7 years maturity, 6.5 duration, right? But let's, for theoretical argument's sake, how much extra does credit pay you? It pays you 1% more. Guess what? 1% is well above post QE average. When I say QE, 2015, that's when the ECB started buying market products. It started with govies, and later on it started buying corporates in a small amount. I'll highlight that later on. But the point is, more than 1% raw premium over the 10-year, which is a much longer duration instrument, bodes very well for credit because it is good. The carry is quite attractive, part one. And two, as we just discussed, that we are going to have a gently wider yield, which should help credit in terms of tighter spreads next year. Next slide, please. The other key factor is what is the ECB doing? Now, I'm sure many of you who followed markets this year know that despite COVID, most asset classes this year are going to deliver positive returns. Why? A massive central bank presence. So the ECB, even before COVID, because of struggling inflation in the Eurozone, was buying bonds, both government and corporate, about 32 billion per month on average. So if you look at 20 billion first, which increased to 32 billion, and later on, they added the pandemic program. So if you look at this chart, the purple lines was the original QE. The yellow lines, the yellow bars are the pandemic program. So right now, in a typical month, I mean, if you exclude months like August and December, sort of low months, the ECB is buying anywhere from 90 to 140 billion, right? Huge. Of which, before the pandemic, ECB was buying 20-25% corporate. Because of the pandemic, they initially had to buy lots of govies, Spain, Italy, and France, where COVID was hitting quite aggressively, and as a result, needed a lot more central bank presence. But now, with lockdowns easing and so on, the ECB is focusing on, its main remit, which is, delivering inflation. If you buy government bonds, you don't deliver inflation. Guess what? All the money spent by the ECB in buying government bonds is going back to the ECB reserve, right? So in essence, it's a zero-sum game. So if you want it to be a net positive game, you need to buy credit. So the ECB has been increasing the corporate share. Corporate share used to be 20 before pandemic, fell to like 6 or 7, and now it is back to 10. Now, translating the 10 to actual amounts is about 10 billion. 10 billion net, which translates to about 11.5, 12 billion gross. 12 billion, 11 to 12 billion gross every month when, let's say, eligible, by the way, the ECB cannot buy all sorts of debt, right? In terms of eligible supply on average is about 25, 30 billion. So the ECB is buying, anywhere between 30 to 1/3 of eligible supply, right? They are involved in almost every new issue. So this presence, and it is not going to go away because the ECB this month is going to expand the pandemic program by another 500 billion, which means it is going to last from June 2021 will be extended to December 2021. So if you're talking about 2021 outlook, we know that January to December, every month on average, the ECB is going to be buying 10 to 12 billion credit gross. Massive. So that is another reason why I believe that it is going to be very difficult for investment grade spreads to go really wide unless you have another crisis. And the likelihood of that, given that we've had just one, very unlikely. Next slide, please. So that brings us to fundamentals. Obviously, this is equity fundamentals as well, not just credit. So how have fundamentals been through COVID? Now, you need to realize even before COVID, companies are getting smarter. They're following the bad example of the US of levering up. Companies delivered, let's say from 2016 to 2019. If you look at the orange line, sorry, the blue line is the more important one. The blue line is debt to EBITDA, leverage, right? So from 2016 to about mid 2018, deliver. While the US was levering up, by the way, American companies were borrowing left, right, and center for mergers, dividends, all sorts of stuff, buybacks. The Europeans were not doing it. Reasonably prudent, leverage was coming down, good. ECB was buying, spreads tighter. But come 2019 to even before COVID, companies were slowly starting to lever up. And then we had COVID-19 hit markets, the companies rather. And as a result, you had a big uptick in leverage. Both the blue line, leverage, and the yellow line, gearing, debt to equity, both of them went up because equity went down, right? So that is in the first quarter of COVID hit, which is Q1 results. Q2 results. Then you had Q3 where lockdowns were getting eased. The earnings hit was not as bad. So the leverage and gearing numbers have stabilized. The leverage is around 2.4. Yes, it is a decade high number, but 2.4 is still not a lot. Why? Because borrowing costs are all-time lows. If you look at where borrowing costs are now for investment grade companies, non-financials, less than, it's about 0.25%, nearly free right now. So given that cost of borrowing is so low, a little bit higher leverage doesn't hurt your ratings. I will show that to you in the next slide. Next slide, please. Right. It looks like a bunch of rainbow squiggly lines, but each line is a rating agency. So what are those lines? The left-hand side is investment grade. The right-hand side is high yield. Left-hand side is the upgrade-downgrade ratio of ratings of investment grade companies, Western Europe. Clearly, ratings have been on an uptick until COVID, right? As I said, leverage uptick was not that high, but costs were very low. So there's been a non-stop uptick in ratings. And in fact, before COVID, we were at around 3.5 times. 3.5 times the number of upgrades to downgrades. But after COVID, sadly, obviously earnings took a hit, and rating agencies tend to be 1 quarter ahead of earnings. So in Q1 itself, we had a drop in earnings, Q2 further drop, Q3 recovery. So you can see big drop in upgrade downgrade ratio of investment grade, uptick in Q3, surprisingly a little bit of downtrend in Q4 because of this second wave. While in high yield, smaller companies, but remember, lot more levered. And here, downtrend, yes, you know, the high yield credit ratings never really got too good. You know, if you look at the upgrade downgrade ratio, it never crossed 1 on average. So which means same number of downgrades and upgrades. But from there, we went to 32 times. Okay, that's S&P. But even if you look at Moody's and Fitch, it's about 16 times. 16 times the ratio of upgrades to downgrades. But interestingly, in the next 2 quarters, both Q3 and Q4, high yield has had a substantial uptick in ratings. So lower costs, central bank presence, and the fact that we now have vaccines, I am fairly confident that investment grade will also turn, and next year the numbers will get slowly towards where we were pre-COVID. I mean, may not be as strong, but I think upgrade downgrade ratios of 1 in both high yield and investment grade are probably a quarter away. Next slide, please. Right. How do downgrades really affect portfolio? I mean, in most of the cases, the portfolio manager doesn't need to sell. But there are two instances when you are forced to. First instance is when a credit gets downgraded from investment grade to junk. They are called fallen angels. So basically from BBB minus to BB plus, that 1 notch downgrade can be quite detrimental. So how many index fallen angels have happened? Obviously, if one rating agency downgrades, you know, it may not matter much. What matters is when you get kicked out of the index. So on the right-hand side, on the left-hand side, I have the chart showing you investment grade index fallen angels. So monthly, how many credits have been kicked out and what volume of fallen angels. Clearly in March and April and May, when Corona was at its worst and rating agencies were trying to price the future, there'll be a lot of fallen angels. There were about, you know, for 6 to 7 fallen angels a month, about 12 to 14 billion at its peak of debt going down to junk, but significantly slowed down in the summer, and now you have 0. So for the last 2 months, there have been no fallen angels. And why? Because most of the dodgy stuff has been taken out already. So I'll prove my point that, okay, the investment grade index is about 2.5 trillion, right? Of which BBB minus debt is about 200 plus billion, of which the debt that is on negative outlook, the BBB minus rating being on negative outlook, is about 87 billion. But obviously negative outlook doesn't mean you get jumped. Negative watch means you are on a short-term, immediate watch to get downgraded. And that is just 3 bonds now. 3 bonds and 3 billion, not a lot. That number, by the way, we publish monthly, this report. That number used to be 15, 20 billion not long back. So most of the debt that is on the cusp has been cleaned out already. So I do not believe that you're going to have this downgrade based hit. Even though they may not get upgraded, that's a different story. But you may not have downgrade based hit in IG. Move on to high yield. Next slide, please. In high yield also there is a, you know, what should I say, a cliff. And what is the cliff? The cliff is defaults. We don't care about downgrades within because the portfolio manager can still hold it. But if you default, you will have to book the losses, right? And you get kicked out of the index, of course. So how many defaults? So it's the same chart correspondingly for European high yield. how many names have been kicked out, and what is the volume of debt. Corona, at that time, it didn't filter into defaults. Obviously, you need earnings to drop and so on. So unlike fallen angels, which are rating based, defaults are actual realization. So actual realization is about a quarter or two behind ratings, right? So unlike investment grade, the chart is towards the right. If you notice the difference, compared to the fallen angel chart, the default chart looks like it is moved to the right. So in April, May, June, there were a few defaults. In September, there were quite a few. There were 4 defaults and nearly 2 billion. Well, guess what? Cleaned out. So in October, 0 defaults. And if you look at the amount of triple C and single C to D, both those bands together, which are the lowest rated, highest risk debt, yes, there is a lot compared to the past, about 35 billion euros. But guess what? It's only 10% of the portfolio. That's the first thing. And also, if you look at just the triple C, double C to D portion, is just 9 bonds. So in terms of stuff that is really, really on the cusp, there are a few, but it is not going to be a lot. So if you look at the left-hand chart, add them all up, what is the index default rate right now? 1.2%. 1.2% in 10 months. You annualize it, it is about 1.4%. So European high yield is running at 1.4%, very low. So that is another reason, and especially with vaccine and central bank presence and more stimulus coming in, I strongly believe that default rate will stay under 2. Under 2. Rolling annual default rate will stay under 2 for the index, which is what I care about. I don't care about non-index stuff because most probably it is not held by most portfolio managers. Next slide, please. Right. How much, what is the return possibility? I'm sure given that it is pension funds on this webinar, you're going to love this slide. This is long-term crisis analysis of credit. How much do you lose in a crisis, top to bottom? And from the bottom, how much do you make in the next 12 months? So how much do you make on the next 12 months is on the y-axis. How much you lost is on the x-axis. Negative, of course, because you lose, right? And surprise, surprise, the gain is directly proportional to the loss and extremely well correlated. And if you look at high yield on the right, they're all on the line. I'm not kidding. They're literally all the 6 crises we've had are on the line. 99% R square. Now, you can ask me, Mahesh, in your 20-year career, is this a shock? Because I didn't have as many crises, by the way, to do this analysis. So now that we have 6 crises, I was quite shocked that particularly in high yield, it is literally to the dot. So if you lose X, you gain 2.25 in high yield. If you lose X, you gain about 1.4 in investment grade. Very well correlated. The investment grade one is not literally on the line. Why? Because you got the Bund impact. Because there's a total returns, you see. The Bund sort of muddles up the relation a little bit on the investment grade side. The Bund impact is minimal in high yield. So that's why the relation is so strong. So how much have we lost in Corona? Corona investment grade, we lost 8%. February to March, by the way, that's the drop. How much have we made? We made about 9% already, but the equation is saying you need to be getting, forget the intercept, by the way, you need to be getting something like 12-13%. So ample return potential next year. The high yield, we've lost 20%, which means you need to be making about 45%. I think 45 is a bit of a stretch. We made 24. There's still 21 left. By the way, this is by end of March next year. So in terms of return potential, there is still ample. At least history says so. And even if you look at spreads now, investment grade is near 90. High yield is near 360, 370. So there is still ample room for compression. Next slide, please. Now, given that we are in asset allocation, now credit versus equity, what's the story? How do you compare? You cannot compare raw. That is completely wrong because the wall of equity is much, much higher than credit. So you need to be doing a beta adjusted relation and then use that beta, because that's what a client would do. They will be checking, okay, this is the normal beta between credit and equity. And that's the beta, by the way, the middle row, normal beta. So that is from ECB starting QE to Corona. So that is normal period, right? So you measure the beta and then you assume that if I am buying investment grade and I'm comparing with equities, you have to compare with 3.1% of stock 600. If you do that, investment grade is ahead. Financials are significantly ahead. Financial credit has substantially beaten financial equity. Investment grade has beaten equity a little bit. High yield is behind equity. So if you compare small stocks versus high yield, beta adjusted, high yield is behind small stocks, both in CDS and in cash. So whether you do main crossover or whether you do Bloomberg Barclays indices, in both the relation holds true. Investment grade is ahead of equities and high yield is behind equities. Financials well ahead of equities. Credit, by the way. Next slide, please. So lastly, before I close, I'm sure given that all of us are now obsessed with social responsibility and being green and ESG and so on, I just wanted to highlight how much of credit is green, right? The total volume of green bonds right now, which is the entire global credit database, what have been identified for green use of proceeds, they get a green sticker. Only 342 billion. Guess what? The total credit in the world is about 15 to 20 trillion, depending on how you measure it. So it's infinitesimal, first thing. Second, Europe obviously leads in green, 165 billion. The Americans, as obviously given the previous presidential administration, have been very slow, 66 billion, but you need to realize the US credit universe is about 78 trillion, so very tiny. China, by the way, for a new market, has same amount of green debt as US. Now, we know Europe leads, but how much of green is in the index? How much of the index is green, right? If you look at that split by utilities, industrials, financials, utilities are disproportionately green, right? More than 20% of utilities is green. Financials about 5%, industrials next to nearly zero, right? So if you look at the blue part is how much of European utility bonds are green and in the index, and the pink line is the percentage, and you can see financials 5%, utilities 22%. Even if you look at it the other way around, if you want to construct a green portfolio, you will end up with about 40-45% utilities, disproportionately utilities weighted, right? Then if you keep going down clockwise, how much of green issuance has happened? Green issuance has been increasing by about 25% every year, on average. It's 25% CAGR, very good. But you are starting from a very small base. So last year, 40 billion, 42. I am fairly confident that this year we'll hit 50. Remember, this chart was done only early October. So October, November, December, I'm fairly confident we'll hit 50. But even if you hit 50, it's only 50 billion, but you need to realize this year we've had tremendous amount of supply. So overall supply also grew about 25%. So the green proportion is not going to increase. Even though the actual volume is increasing by 25%, its share is not going to increase. So is there any point in investing in green credit? That's the left chart. Looking at Corona, yes, green credit behaved like a low beta portion of credit. They didn't lose as much, and afterwards they gained a little bit more. So net, they're about 26, 24 basis points ahead, which is not bad, by the way. This is by beginning of mid-October. By mid-October, 25 basis points is reasonable because the index itself returned 60 basis points negative. So you are ahead by 24 basis points, which is statistically significant. So green definitely beat the index during COVID. Green is small, it is growing well, but share is still stuck at around 3%. Next slide, please. Now, given that we are talking about research and how do we navigate these waters, Bloomberg Intelligence is the research platform of Bloomberg LP. It is a massive platform. We are talking about nearly 350 research people. I don't think there is any other street franchise this big and this large and fully independent and free if you have the terminal. So I'm free to talk to if you have a Bloomberg terminal license. Now, which is not the case if I was in any of my 4 bank avatars, right? So all sort of markets are covered: fixed income, credit, currencies, commodities, equities, all single name. We are talking about 2,000 companies, single name equity. We are talking about 450 single name credit, and government, litigation, regulation. In addition to all these markets and single name is covered. Amazingly broad platform. Even I didn't know, by the way, until I joined. So if you go onto the terminal and check it out, it is an extremely, extremely valuable resource, independent. Next slide, please. With that, I conclude my presentation. I am very glad that all of you have patiently listened to me. I have a few polling questions, and I would like to take a poll of what you guys think on related topics. Adrian, would you mind popping the polling questions, please? Right, first question. Which European asset class will do better in 2021? Rates, bonds and rates, investment grade credit, high yield credit, or equities? Equities has to be beta adjusted, by the way, right? And it says high yield next year 48%. I think so too. I think so too. Okay, next question, please. Yes. What will be the key driver of asset returns? COVID, ECB. I'm talking about European asset returns. ECB, Brexit, or any US stimulus, because the European stimulus is going to take a while, right? So because US stimulus is being discussed now. So COVID, ECB, Brexit, US stimulus. Which is the key driver for asset returns in Europe? Excellent. COVID and ECB. I agree with that. Next question, please. Right. Will 2021 beat 2020 returns for credit and equity? Yes, no, almost the same. I can see that we are very bullish. 65% of the voters believe that 2021 will beat 2020. Amazing. I agree with that too, but not by a lot. I'm probably in almost the same camp. So next question, please. Last question, I think. Do you prefer US assets over European assets for 2021? US, Europe, indifferent. Currency adjusted, obviously it needs to be measured in the same currency. US by margin. Thank you all, very useful. I hope my webinar was very informative and you enjoyed the polling. With this, I pass on to Bobby Lilaram. Bobby, you can take over.
Thank you, Mahesh. That was very insightful. And from my section, I'm just going to build to a large degree what Mahesh covered and just go into a more of a framework. So if we can just go to the next slide and we'll kick off with the agenda. So I'm going to review a little bit on what happened in 2020, in addition to what Mahesh has already spoken about, and build upon that and maybe look at it in a slightly different perspective, introduce then an outlook for 2021 and beyond, but also demonstrate how an investment framework is much needed, particularly when it comes to asset allocation decisions and making sure they're constructed in an optimal way. And of course, we'll then have concluding remarks. So if we can go to the next slide, please. So part of what Mahesh talked about earlier was ECB support. And ECB support is really on two sides, asset purchases as well as lending. If we look at the lending itself, shown by the top chart here, the lending to credit institutions has actually been up from 600 billion to 1.8 trillion in 2020. That's 300% increase. That is quite staggering. Of course, largely as a response to the current pandemic that we're going through, which hopefully for all our sakes ends pretty soon. The balance sheet activity as well, you can see it's up 3.5 trillion in securities. That's 40% increase on a year-to-date basis. And Mahesh showed that in part of his presentation as well. If we move to the next slide, the additional provisions that were introduced as part of the PEP program have been increased to 1.35 trillion, as Mahesh mentioned. Now, the current holdings, if you will, stand at 565 billion. So as he said, the expectation that the purchases, particularly on the PEP program, is likely to increase all the way through to 2022, at least lasting the entire year of 2021. Interest rates, of course, will remain in negative territory. I highly think that won't change anytime soon. But what is quite interesting is when Mahesh mentioned the comparison between the United States and Europe, the inflation forecast stood out. And that's because the Fed realized this. The Fed realized that if inflation starts to pick up above 2%, the last thing that they want to do is any action that could curtail that little bit of inflation. So there were talks already in the Fed that they will allow for inflation to move above 2%. The ECB, interestingly enough, are also adopting similar talks, which is a very positive signal, particularly beyond 2021, that the economy could be set up for a nice recovery without being curtailed too much by any contractionary measures. If we could move to the next slide, please. Now, from a borrowings perspective, commercial bank loans actually didn't increase in 2020. In fact, if we look at the 2 quarters here stipulated in the chart, you'll see that there's a reduction in the commercial bank loans. So perhaps the ECB injection hasn't quite been carried on to the same level when it comes to corporate lending from banks. However, debt issuance, on the other hand, is up already 19%, and we still have another quarter to go. The results here are as of Q3 2020. And interestingly, the comparison that you can see on the little GIF below is the levels of increase in this year when we're moving towards a contractionary period in the economy compared to that of, say, 2008 and the year that preceded just before the global financial crisis. It's a reflection of how cheap debt is, but it is interesting to observe how that debt is being used. And with that, I'd like to move to the next slide, please. Now, in terms of how the debt's being used, again, Mahesh mentioned the idea of leverage, but I want to point out a couple of things here. First of all, from a gross debt to EBITDA perspective, again, looking at the stock 600 here, you'll see that the leverage on a gross basis is at its all-time high since 2012. So it is a very significant amount. However, the net debt to EBITDA is not at its highest since 2012. In fact, the disparity between the gross debt to EBITDA and the net debt to EBITDA clearly indicates that there is a lot of cash being held on the balance sheet. And the reason for that is primarily as a liquidity buffer to curtail the coronavirus situation and the potential slowdown in business operations that come with it. And you can see that very clearly from the chart below, which is plotting free cash flow to the firm. And that's an interesting observation that we see in Europe, particularly in terms of how this debt is being issued. As Mahesh mentioned, debt right now is very, very cheap. So having access to that is favorable to a large degree for corporations. However, the spending of that debt may not necessarily be at its most optimal, considering how much cash is being held just to curtail any potential downfall. Now, before we move on to the next slide, I'd like to ask a couple of polling questions just to make sure that the expectations are in line as well. So if we can bring up the first poll, please. So the first question is, what is the bigger challenge for you in this current environment? Would it be managing volatility or seeking superior returns? So as expected, I would imagine that managing volatility is going to be a much bigger risk. It's in line with my expectations and something we'll talk about as well as the presentation goes on. But it's interesting to see how everyone here looks at that as the bigger factor. If we can move to the second polling question, please. Do you believe the traditional 60-40 asset allocation is still optimal? So 60% equity, 40% debt. Do you believe that it is still an optimal asset allocation strategy to use? Overwhelming majority here saying no. Again, in line with my expectations as well, and something that I'll build on. But it's great to see. I mean, we looked at the Bank of America paper that was released. Gosh, I think it was this time last year, or maybe a little bit earlier, that basically called death to the 60-40 asset allocation, and then that was even before the pandemic. So it's certainly an interesting point. So thank you for participating on the poll. And with that, I'd like to move to the next slide to continue the presentation. So from I think we've already covered this slide. So please, if we move to the next slide and the next one. I think there's an issue here. Here we go. Perfect. So the key observations that we've talked about: lending to credit institutions up 600 to 1.8 trillion, the pandemic emergency purchase program, etc. Now, with that in mind, if we were to look at a potential outlook for 2021, it's definitely going to be one of continually loose monetary and fiscal policy, supporting both liquidity and asset purchase and valuations, for majority of the reasons that have already been mentioned at the beginning of this presentation. Now, the vaccine results from Moderna and Pfizer are certainly encouraging and already had a bit of a bounce and rotation in the market, particularly on the equity side, where value have seemed to outperform now momentum. But that race for the COVID vaccine, amidst the slowdown that's happening because of the second lockdown in Europe, still introduces additional potential risk. And as the majority of you overwhelmingly voted for managing volatility as your bigger challenge, it's unsurprising that this market's introducing a lot of volatility. So the improving global growth forecast may change that expected V-shaped recovery to a W-shaped recovery, given what's happening with the lockdown and how quickly we can roll out the vaccine. And with that in mind, there's going to be a large expected negative real returns, particularly on cash held as inflation starts to build. So we have to be careful with making sure that cash is as fully invested as possible. There is a large paradigm shift already towards remote working and technology solutions. As with any sort of investment, it's going to be done for a longer term. So these technology solutions that people have been purchasing for themselves and corporations have been adopting is unlikely to go away as we move toward a new normal world. So that paradigm shift may still continue. And post-Brexit transition introduces even more uncertainty to the equation that's already been coming in from the pandemic and years of central bank easing and when that's likely to curtail. Although not next year, it's certainly something to consider. So additional volatility to definitely take into account. If we move to the next slide, please. Now, I introduce here a framework for the asset allocation. On the top right quadrant, we have the actual strategic and tactical asset allocation that we'll come up with based on the views that we've seen and what expected to happen in 2021 and beyond. What's important then to do is use the information to come up with those views, is to then optimally construct a portfolio. So moving clockwise down to the bottom right quadrant. And for that, we need volatility data, asset return data, correlation data, and an optimizer to make sure we're efficiently allocating along the efficient frontier. Continuing clockwise, the portfolio implementation is very important. You need to be able to rebalance your portfolios in an effective and quick way. You need to make sure you check regulatory limits as well, adhering to mandate requirements, ensuring that execution is done in a swift fashion and settlement instructions can be sent out as well to your custodian. And then it comes to the actual review itself. you need to make sure you continually review your asset allocation and your construction of your portfolio to ensure that it's still living up to its levels. With that in mind, you need to make sure you have a strategic benchmark that you can compare relative to, do adequate performance reporting, attribute relative to factors, not just asset classes, and conduct stress testing to see the robustness of the asset allocation. And of course, the wheel then continues to make tweaks when it comes to tactical decisions and continues all the way throughout. If we move to the next slide. Now, I'm not going to focus on the entire wheel because we don't have too much time in the presentation. So I'm going to focus on two aspects, the portfolio construction and the portfolio review. Now, from a portfolio construction perspective, we've already talked about how asset prices right now are really disconnected from the real economy, and the resolution of the current health crisis is extremely uncertain. The investment horizon is therefore going to be one of very, very high volatility, but low returns. And I think that's something that's going to be expected for some time. Therefore, it becomes very imperative that diversification is done on portfolios and risk mitigation portfolios are created, going beyond the traditional 60-40 construct, which an overwhelming majority of you agreed with. We already talked about cash not being a safe investment because it will likely produce a negative real return. So once again, we have to make sure we're fully invested. And the other paradigm, well, not paradigm shift, but the other trend that we see emerging, and this has been now, I would say, for a couple of years, but definitely ramping up at the moment, is introduction to alternative asset classes in the asset allocation to cushion not only against the W-shaped recovery, but to introduce further diversification in the portfolio in the goal to create risk mitigation portfolios. If we move to the next slide. Now, looking at some of those points, I think it becomes vital that risk management needs to be coupled with having a timely risk model that can capture cross-asset correlations and volatilities. That's something that Bloomberg provides. So you can see from the chart that we have variance-covariance matrices that show you the correlation as well as the variance-covariance across different factors in our factor model. The responsiveness has to be in line with market volatilities. And with that, Bloomberg have made a vast investment in the new MAC3 model. From the chart on the top right, you will observe that the purple line dictates our MAC3 model and the gray line dictates the VIX. Now, the market volatility or the projected expected implied volatility of the VIX is very closely being mirrored here by our MAC3 model, showing that we're getting much closer to getting in touch with the actual market volatility, which if we think of the month of March was crucial considering how many big moves there were in a short period of time. Therefore, having a timely or a daily risk model that reacts in a quick enough way to give you your risk expectations and to basically look at your overall portfolio volatility and allows you to reshape that becomes very crucial. It requires a large data set across asset classes. And also you need to make sure the term structure of risk is taken into account. If you look at the bottom right, we all intuitively know that volatility in the short end would never really be the same as volatility in the long end. So to use a square root of time approach is a little bit outdated, and the coronavirus definitely exemplified that. So being able to have differentiation in terms of long-term and short-term spikes is something that Bloomberg's invested as well in the risk model in order to make it the best in class. If we move to the next slide, please. Now, I talked about exposure to alternative asset classes. You can see here from the frontier diagram that I have, which is using the optimizer in the port application, an introduction to the alternative asset class clearly does reduce the overall expected risk, as we would expect, because of diversification benefits. The important thing to highlight here is that we can actually capture the risk of the alternative asset class within our risk model in Bloomberg. Now, Bloomberg have recently partnered with Goldman Sachs Asset Management as well to come up with a series of risk premia indices that could be used directly tradable and used as part of your asset allocation. Now, this is done on a cross-asset basis, but you have each component that is obviously then weighted and put back into the overall cross-asset index. The actual premias that are there are carry, trend, or momentum, and value across all the different indices, long, short in nature. Now, if I was to look at the segment on the top right, and just to introduce how this would actually help, what I'm having here is an asset allocation optimal weight finder. With objective 1, which is to reduce the overall portfolio risk, you can see that a maximum allocation of 15 is given to the risk premia index as signified by the purple box. Again, unsurprising, but you can see that it's actually maxing out the allocation because of purely how different the returns are for the risk premia compared to traditional asset returns. If you look at objective 5 as well, this is another one that looks to reduce the risk for a given level of return. In this case, I've put in a given level of return about 5.6%. And once again, I've got the maximum allocation for the risk premia index. And if we look at objective 3 finally, which is in the middle, it's about Sharpe ratio. Once again here, I've got a pretty sizable allocation in this risk premia index, close to 10%. That shows that not only it introduces portfolio diversification, but also gives you that perspective for alpha, because on a risk-adjusted basis, it's actually giving a significant allocation to that asset class. So that's something that may also want to be considered when it comes to having and introducing alternative asset exposure into your portfolio, going beyond just hedge funds, private equity, and so on. If we move to the next slide, please. Now, for risk mitigation portfolio construction, it's very important to have an optimization function to arrive at those allocations. On the top left, you will see a segment of our optimizer, which is on Bloomberg Port. And you can see here that you have a goal which you can set, which in this case is contribution to total risk, which I can then separate out into either a segment of my portfolio or my strategic benchmark, or indeed an asset class, or indeed individual assets themselves. We know that portfolio construction methodologies could be either driven by weights, by return and risk, or by risk allocation. In this case, we're looking at risk allocation, but I could equally put in here an expected return and minimized risk criterion to go with the traditional Markowitz risk and return optimizer. I could even get in maybe returns implied from Black-Litterman and put them into the optimizer, and once again, come up with a set of results for my optimal allocation. We do have a very sophisticated engine that's perfectly fine-tuned to be quick as well as being accurate. And that's something that's important to highlight, and uses the risk model. Next slide, please. Now, in terms of reviewing the portfolio asset allocation, it's very important to make sure that we do that. It's important to make sure that we compare the portfolio performance against a strategic benchmark, attribute performance relative to each bet, and factor bets, and stress test as well to make sure it does hold up in different situations. If we move to the next slide, please. This is an easy example that's used more for demonstration than an actual way to asset allocate. But here you have a histogram or a scatter plot that can actually show you how your return drivers are in a specific time period, which in this case is looking at September 30th to October 28th. Now you can see here, the size of the bubble denotes how much weight you have in that particular segment. And the axes will denote how much return, the y-axis will denote how much return has actually been made in that period. Immediately, I can see emerging markets, for instance, is a high driver in terms of a weighted return, so a contribution to return in my strategic benchmark. That's interesting because I don't have that much allocation toward it. So maybe if I look at this purely and very simplistically from a performance perspective, I can say that I might want to allocate more to emerging markets should everything else line up as well. So when you come back to that wheel and you're making tactical bets, looking at performance is very important, and being able to attribute the performance, as you can see on the left-hand side here, by the different segments of your asset class, be it global equity, global fixed income, or alternatives. If we move to the next slide, please. Stress testing is very, very widely used for this context. Now, I have a few scenarios here, once again, against my strategic benchmark. I've got the equity markets rebound of 2009, which directly followed the Lehman crisis, where equity markets, of course, rallied. I have the Lehman crisis itself of 2008. I have a scenario called the Corona apocalypse, which is replicating the month of March. And I have a euro sell-off against the dollar. Now here you can see the results as they're coming in, not only at top level, not only at top asset allocation level, but at each individual segment as well. So for instance, I can see that global rates, for instance, would have lost the least because of the flight to quality during the Lehman crisis. And with that, I can try to understand how any of these scenarios, if it were to replicate itself right now, so maybe a repeat of the Corona apocalypse or the month of March or a Lehman crisis, or indeed even a rebound, as we're seeing maybe a couple of days now, but if that was to continue, how that could influence the performance. But what I can then do is re-optimize my portfolio to make sure that the results of those particular scenarios are optimal. So in this case, I can set up a goal to maximize the P&L that I get on the Corona apocalypse scenario, for instance, or another way to look at it, minimize the loss due to the coronavirus scenario, and see, making sure that my overall tracking error still remains the same, and see for along the efficient frontier for varying levels of my tracking error, how much I could potentially reduce that loss and make my asset allocation that much more robust if any of these scenarios were to happen again. Next slide, please. Now, as well as being able to use the functionality on screen, we have a vast amount of reporting capabilities with our Bloomberg Port Enterprise solution. And you can then leverage Power BI to produce very beautiful reports that can be consumed not only on the desktop, but also on mobile. And I thought that would be something to point out here for your attribution and scenario reports particularly. Next slide, please. Now, you can see the different areas, and we, of course, only spoke about 2 of the areas, are all available on the Bloomberg solution. So using the Bloomberg terminal to get the data, as well as leveraging people like Mahesh on the BI team, from portfolio construction using the optimizer on Port, for the implementation using Bloomberg's order and execution management system, and then finally, from a reporting perspective, using Bloomberg Port Enterprise, is all powered by Bloomberg data, as you can see on the box on the outside. And that gives you a consistent view of the world and gives you access to only one vendor that can give you a holistic view to help you with the framework. Next slide, please. So to conclude, it's very important to have a framework, of course, to make sure that this can be done in a systematic way. Having access to timely and robust risk models is very important, particularly right now for optimal portfolio construction, given the markets that we're in. An efficient, streamlined order management and execution capabilities is always a must to make sure there are no trade fails and everything is done in a quick and efficient manner. The ability to report performance of your allocation and create those tactical tweaks via scenario stress testing and performance as well is vital, because you need to make sure you continue to review the investment framework, and to have one single infrastructure to do all of that becomes very important. So that will conclude my part. I would like to hand over now to Fred to continue the rest of this presentation, and I thank you for your attention on my part and participation on the polls. So Fred, over to you.
Thank you so much, Bobby and Mahesh. And I know we've slightly gone over time, so I'll be very brief. If you want to just bring up the next slide, please. Thank you all so much for joining today, and I hope that you've been able to gather a few key takeaways from the event. Thank you also to the PLSA for partnering with us around education. It's something that's very important to our culture and development. Educational sessions have always been something that I've hoped to bring about at Bloomberg within the UK asset owner world. Ever since starting working with the LGPS pension funds 5 years ago, we have always felt that raising awareness around the combination of market themes and technology solutions to fit could be a powerful concept. This year has definitely thrown us many challenges. However, we at Bloomberg have been working even harder to try and cater for the needs of our clients, and especially asset owners, due to their requirements becoming more complex. Fiduciary management, regulation, and needs for one portfolio or IBORs have become the driving factor of data or technology change. In the slide that you can see now that we have asset owner solutions for all types. Whether you fit into the hybrid, internal, or externally managed fund categories, we can help with these challenges to facilitate better workflows and more efficient, streamlined, or automated ways. We all now have to work with technology in some shape or form in this very remote working environment. It's inescapable if you need to continue to grow, manage, scale, regulate, build, and progress in the 21st century. Tools to view performance, risk, attribution, compliance, and research that we went through today are critical to gaining insight and give you a greater understanding of how your investments are stacking up. Today, we have presented a few key strains of technology and data that are available on Bloomberg, and most importantly, the solutions that give better oversight for asset allocation. We thank you for your time and look forward to keeping the conversation open. I don't think we're going to get through the questions, but if you'd like to contact us, please go to the PLSA Educational Partners website, where you'll find all the information needed, clicking on the Bloomberg icon. We'll also be running further webinars, the next one in December, to continue to delve deeper into the technology and data world. Thank you so much, and I'll pass over to Adrian, who will be moderating, who will be there for closing. Thank you so much.
Thank you very much, Fred. And yes, apologies, we've run over time, so unfortunately no chance for Q&A, but please do send your questions into the team. All that remains for me is to thank Mahesh, Bobby and Fred for a very detailed and informative presentation, for their support as an education partner. And I would like to just highlight that they will be doing another webinar as part of a series on the 14th of December. So we hope that you'll all be able to join us for that. Thank you very much for your attendance, for taking part in the polls, and we look forward to a future presentation with you. Have a good day.